Hello everybody, Jim Malone coming to you live on Dallas Trading Floor. It is Tuesday, and the market, well, you know, after the split of Amazon, it's off a little bit, but we have a few things, so let's get into the slides and see where it goes. All right, so basically, Target today warned on earnings, and you know, that is not a good sign. Why? Because Target is one of the biggest retailers, obviously, and of course, this is the second time that they have warned. So, my guess is we're going to see some weakness in the retail space. So, get ready for that. I think that this summer, you know, I think that the consumer is kind of tapped out. Let's take a look at the chart, just kind of showing you kind of what's happening. You know, we had this earnings disaster, basically, and we had this gap down all the way from about 220 all the way down to about 160. Then it sort of recovered again, but now Target is saying its projections are showing it's going to be weak. So, you know, this is something that I think we've got to get ready for. We're in a relief rally right now. And, you know, right now we're moving up, but, you know, we could be moving back down very, very quickly. So we have to be very careful right here. Just a tough market to trade all the way around. Just wanted to show you, you know, again, the target response is basically, you know, the reason that they're warning is so that they won't get their stock, you know, crushed. But, you know, this is a harbinger of things. We've got to be very careful. I do think that there's just going to be a lot of weakness in the retail because of so much inflation. So much of the budget for many households is going to oil and food. So even in those sectors, we've got to be careful. But interestingly enough, all of the major oil companies seems to have done well today. I'll get to that in just a second. Here is the result of the small portfolio. This is a demonstration portfolio that I show to everybody, kind of how I'm trading. This is actual trades. Really, I'm only in two things right now, which is Chevron, which was up nicely today, and a ETF called the TBT, which tracks the long bond, and when the interest rates go up, so goes this one up. So let's take a look at those two just really quick here. The first one, of course, is Chevron CVX. This is kind of a slow mover, but you know, it's still in the buy zone, just barely. I want to kind of show you that one. We're just still in the buy zone, but we had a nice gap up today. After hours, it's a little bit up. It's at 180, but we're still in the buy zone. This is still actionable, believe it or not. You can still buy at these levels, and it has a strong checklist, 89%, and it's looking, I think it's going to go higher. My guess is these large integrateds are going to do very, very well. We're only about 2.12% off the 10-day moving average. That means that, you know, we may see some more action up now that we have cleared the 174.54 buy point on Chevron. Now, what buy points are is they're areas of resistance, and if we can move past those areas of resistance, many times it can be a very good thing. The other thing that I'm holding currently in the small portfolio is this ETF called TBT. That's the symbol for it, and it is also, it's the ProShares Ultra Short 20+ year bond fund, and this one is looking pretty decent too. I was buying it right as it pulled back to the 21-day line. I don't recommend buying at this level, only because we're just too far away from that 21-day line. The buy point on this one was way back here, basically with a cup with handle formation. The buy point 21.97, so I don't recommend buying at this level because I bought on the pullback to the 21-day line, and it is above the pivot. So this is a little bit extended, And I don't recommend buying this one at this level, but the reason I bought it, of course, was when I had the opportunity, when it pulled back to that 21-day line, that's sort of where I was in. That's sort of where I was in the issue. Also wanted to show you 3 actionable stocks right now. I did take off On Semiconductor. I had it on yesterday. All of these stocks remain actionable, something that I think you might be very, very interested in. One of them is Precision Drilling. This is a Canadian company, and it is symbol on that one is PDS, Precision Drilling System. Pretty simple. Looking pretty darn good. We're right at the buy point. Let me show you this chart. I think this is a nice chart. We had some nice action on it today. This is being accumulated, I believe, by some of the funds, and it is the buy point on this is 85.29. We're right above that at 85.39. So we're still in the buy zone on this one, and this one is actionable. Now it is a little bit far off the 10-day. It's a little bit more than I want to buy it at 5.96, but I think it is definitely actionable here. On the pattern rec. On this one, it's basically right at the pivot, so this one is actionable as well. So kind of a cool one. Now, for the industry area, this one was up today. This whole oil and gas drilling has been an area of a lot of activity. The whole sector is up 1.4% today. Year to date, it's up 105%. So this is where you should be fishing, because this is where the fish are biting, because the oil and gas drilling, very good area. As we see the shortages, we're going to see more action in this area. There's other ones in this group too, like Halliburton, but PDS, Precision Drilling, is really set up very, very nicely. I also have another one here that I'm trying to buy right now. I haven't bought it yet, and this is also an integrated oil company. This is quite a large oil company, but it doesn't operate in the United States. It is a Colombian company. But the key here, and the reason why I like this one, is because it's called Ecopetrol SA. The reason I like this one is that they have refining capacity, and right now we're in a shortage of diesel fuel, and that's a worldwide thing. And by the way, if you can produce diesel fuel, you can sell it for dollars in the international market. So this one has a nice uptrending relative strength rise. The relative strength is 95 and rising, which is good. Pretty, basically flat after hours, but overall looking pretty decent. On the checklist, and this is what I really, really like about this one, this is a $17 stock, and it's got a 100% checklist, and it's in an area of the market that I think is very, very powerful. This is the oil and gas integrated area, which I believe is one of the top areas right now in the market. So let's take a look at the group. I have quite a few holdings in this area. And this is kind of where how it lays out. Of course, ExxonMobil is the number one. Everyone's heard of that one. I'm in Chevron, of course, and then I'm also in Shell. Now, Total is a French company and if you go down here, BP is also at essentially a buy point as well. This is also in the same group, and then of course this is one that I kind of like. And we'll see how it does. But the symbol on this one is. The symbol on this one is EC. It's down here. Fairly large capitalization, about $35 billion in terms of cap. So a lot of capitalization there. It's bigger. It's a little bit smaller. It's a little bit bigger than Gazprom, which is, of course, if you know that's the largest oil company basically in Russia. And of course, they're out of action, of course, because of the war. And also just slightly above Marathon Oil in terms of size. So this is one I think is good. I don't own it yet. I'm trying to get a fill on this one. We'll see what happens tomorrow. But this one's EC. Another actionable stock that I like right now is, of course, British Petroleum. Everyone's heard of this one, but this is at a buy point. And I know that this isn't definitely as exciting as buying the latest tech companies. I mean, this is old BP. I mean, this has been around for just ever and a day, but it's moving nicely into a very nice pattern. It's coming out of this cup base. I've bought twice here. It's right now at the pivot, so it is actionable right now. This one is actionable right now at 34.13. That's the pivot. So it's still buyable. Symbol on this one, of course, is BP. Pretty straightforward. The checklist on this one, not quite as good as EC, but pretty good. 89% checklist on this one. Let's look at the technicals. 10-day, we're right. We're within 5% of that 10-day line. That's kind of where I like to buy it. Strategy-wise. So we're at the buy point, and we're basically within 5% of the 10-day line. That's not a bad place to buy it. This is the second time I have two positions in it, but and I may buy more. But right now, I think this one is also a very good one that you could possibly use right now. So these are the actionable stocks with buy points right now that I'm looking at. I also, just for grins here, I have three what I call penny stocks. Now, my definition of penny is a little bit different than a lot of other people, but these are three actionable stocks that are below $10 in price. Now, why do I consider that a penny stock? Well, typically a fund that buys stock, mutual fund, that kind of thing, they typically limit their purchases to stocks that are above $10. So these are all below $10, but they're looking fairly strong. One of the ones I like is a Continental Development. Let's look at that CDEV. CDEV is the symbol for Continental. And there we go. This one is basically a Permian Basin play. And Permian Basin, of course, is the largest production area probably in the United States. It's one of the largest in the world. This is where we've been getting a lot of the oil and gas for the United States. Of course, at the beginning of the Biden administration, many of the leases in the Gulf of Mexico were shut down. So and they're not going to lease in Alaska. But Permian is primarily privately owned. So this is a good area. I think we're going to see some nice action here. This one has moved up right up to the buy point. This is a strong stock. It's almost out of the penny stock area. After hours, this one's up to $9.58. We're right at the buy point, and this one probably is going to move higher during this week. Now, it probably will pull back, and then we'll see. Not quite as strong as a checklist as some of the other ones that are, that I presented before, but not bad at all. 78%. On the pattern rack, we're basically right at the pivot right now. So the thing is, you want to see, but on buying this one, you want to see it move past this $9.58 buy point. But I do think that we're going to see some nice action there. Unfortunately, it may be a little bit tricky. You may not want to buy this one tomorrow because it is it's about 18% above that 10-day line. So that means it's going to be, it may get rejected at the buy point. So this is kind of a watch and see. You don't really want to buy this one directly tomorrow because it probably will pull back a little bit, but the overall action here is upward. So that's one you might want to look at as well. Now, two of the other ones are not oil plays. These are LNG plays and shipping plays. I'm going to look at Safe Bulkers first, SB. The reason these shipping companies have been doing so well, of course, is because of the war in Ukraine. They haul bulk things like wheat and grains and that kind of thing. So they typically are doing pretty well. Now, Safe Bulkers, not a very expensive stock, $5.01. It's right at the buy point, and we have some nice relative strength at 94. So this is one you might want to consider. It's not that big a stock. I mean, it's not a huge company, but it's right now on that 10-day line. It's 4.6% above the 10-day line, meaning that this is probably a good place to buy it as it moves above the buy point within 5% of that 10-day line. That's a good place to possibly look at purchasing it. It's with a cup with handle formation, which is quite good. And if we go back to the weekly chart here on this one, let's do it. You will see that we're almost at the all-time high for this one, Safe Bulkers SB. Now, let's take a look at the fundamentals on this one. The sales have been going up nicely. The last reported sales were up 24%. Profits, though, that's the key, up 71% quarter over quarter. And prior to that, it was up 75%. So these tend to be doing well, really well. This is a dry bulk fleet of 40 vessels, and it basically is doing quite well. So Safe Bulkers is the name of this one that is on the sort of the penny stock list. And the last one before we get into the next feature is the last one we have today is DLNG. This is an LNG play, and this one, unlike the symbols LNG, FLNG, and GLNG, it's in the same business. But this one's a lot cheaper in terms of its price. Now, that's not necessarily good or bad, but it just is. This one is 97 relative strength. It's right at a buy point too. So that's one of the things about this one that you might want to write this one down, DLNG, and I think it's right at a buy point, and we could see this one move higher. Now, this is not a very big company. It only has 6 LNG carriers. But right now, LNG transport is a big deal, and this one is, it's pretty good. So kind of to review the cheapy stocks, CDEV, CDEV, Safe Bulkers, SB, and DLNG. These are all at buy points and definitely ready to go. But I would, if you are looking to buy, I would kind of try to look at the ones that are actionable, that are more mainstream, and of course that's PDS, Precision Drilling, EC, and British Petroleum. So those are the ones that's kind of where we're at right now in the market, because we're mostly in stocks that are oil related or or thereabouts. All right, well, let's take a look at kind of all the issues that I currently own. Up quite nicely on Chevron today. Little bit down on Flex LNG. Now I did sell half of my position in FLNG. Pretty good. This one is an LNG carrier as well. Also, this one is the TBT. This is the inverse of the interest rates. So as the interest rates go up, this one also goes up. This is off a little bit today, but I have a lot of confidence in this one because I do expect the long bond to move higher, and that would make this move higher as well. BP, of course, that's the one we just talked about. This is up today. This is still in the buy range, so this is still buyable. I think that these large integrated oil companies, especially ones that have refining capacity, are going to do great. All right, and then also Baker Hughes. This is a driller in the oil patch. Shell, of course, everybody's heard of that. That's a big oil company, and GLNG is down a little bit today. So that's kind of where it stands with those, with those issues. All right. Before we get to questions, I have a thing I'd like to show here, and that is we did put a bear put spread on American Express today, and if you want to find out more about that, super easy to do. Just go to this address, https://bit.ly, bit.ly/DTF, that should be DTF, I'm sorry, DFT01 153. Now what I'll do on this one is I will put this up on the website, Dallas Trading Floor. I'll put this up after the show, so you just be able to click a link, and it'll be a lot easier to get to this one. But we kind of want to show you what I was doing here with with this spread. American Express closed at 168.69 today. Do expect American Express to move lower over the following months. Now, part of the reason, of course, is because I just think there's going to be lower retail spending, and that's based on what happened with Target. Lower retail spending probably will mean lower business spending, and I do think lower everything spending, and that's going to be, I think, the case for American Express. Now, this is where I did do the short here. The reason for this, of course, is that as the red line is coming down to the black line, that's the death cross right there, and that's something that if you're looking at it at a signal that is most likely to go lower, that's it. What happened was we've got the death cross. It's the price of American Express pulled below the 50-day line. It's rallied up to the 200-day line, and now it looks like it's going to get rejected and probably going to go lower. So hopefully this will work. Basically, the way this works is if we're able to get, as it goes lower, it doesn't have to go lower that much lower, about 4 to 5%, and we're going to be in the green here. But we do have potential. We do have potential of almost a 2.5 to 1 return on this one. The maximum risk on this one for 2 contracts, $572, and the maximum return I think that we can see is $1,400, and this is in about a little bit under 2 months. So hopefully this will work very, very well, and because I do believe we're going to see a retreat in the price of American Express, and if we do, that will make this one work. So if you're interested in this one, I'm going to be putting this up on the link at www.dallastradingfloor.com. It's not up there currently, but I'm going to put this one up. This is going to be a link to the bear trade on American Express if you're interested in that one. So without further ado, thanks for holding on here, and let's get to some questions. Thank you for going here. All right, not so much tap down, but watching, spending closely, keep strict emergency fund. Absolutely. I hope this isn't, I literally hope this isn't the problem. I mean, I hope it's not going to get really bad, but, I'm just seeing these signs, these gathering storm clouds, and it's not just me. I think, people are going to be paying $10 a gallon for gasoline in California. I mean, we're paying over $4 a gallon here in Dallas, which usually has some of the lowest gas prices in the United States. So that's significant. A lot of those people are going to be cutting back on all kinds of things based on those prices. So I totally agree with you. I totally agree with you. Let's take a question from TikTok. Thank you very, very much for looking at my show. All right. Do you think XHB will continue to fall? Let's look at XHB. That is obviously that's obviously an ETF. Let's take a look at it. XHB, and let's pull over to there. There we go. So basically, this is the home builders. This is the S&P Home Builder Index. I do think that these will continue to move lower. And the part of the reason I do is, let me just show you this chart. We've got the death cross going on here, okay? We've got a trend downward speaking. Interest rates are going up. So a lot of people that could qualify to buy a home 2 or 3 months ago now can't qualify because the interest rates are significantly higher. So I see a real problem with the home builders. I don't think they're going to do well. I'm not trying to show shade on anybody, but I think that if you are in a contract, we're going to see a lot of weakness in the home builders. Why? Because people want to buy their homes, but they simply can't qualify for the for the mortgages. So here's the thing: if you're down more than 7%, and I keep saying this, but this really holds true, and I know this may be painful for you. So, I'm just offering this up as a is a kind of way to say. So, if you're down more than 7% from where you bought this, the XHB, if you're down more than 7%, sell it, and sell it because you could be down more tomorrow. Because overall, I just see a lot of weakness in the market. Interest rates are going up. Home builders are not going to be able to sell their finished product. There's a supply chain problem. Now, lumber prices have fallen, but there's a supply chain problem for appliances and a lot of the other things that go into those new homes. So I don't think it is a good time to be in the home builders. And if you're down more than 7%, I would just consider selling. That's always the best rule to use because you just want to preserve your capital. That's a very, very key thing that you want to do. You always want to do is preserve your capital. So if you're down more than 7%, think about selling. All right. Did you see XOM is up 4% today? Okay, this goes back to the theme of the big oils. And as you know, of course, from the little preamble here, we're holding some of the big oils, basically BP, Shell, Chevron. I don't own ExxonMobil, but it's the same kind of situation. The only reason I didn't buy ExxonMobil, of course, is because of the of the fact that I have the other ones. Now, the XOP is the is the oil and gas spider, and it's doing great, of course, because that's where the action in the market is in the the oil and gas area. I mean, look at this; it's up nicely. Now, would I buy it here? No. Why? Because it's just a little bit too extended right now, and you can see in the after hours it came off. This is one of the reasons you don't want to buy extended. And what do I mean by that? Well, typically a stock will not go up straight. It'll come up and then it'll pull back and then it'll pull up and pull back. So I typically, if I can't buy it at a buy point, which is off of a base, I want to find a secondary buy point, which is typically the 21-day line. I want to buy it as close to that 21-day line as I possibly can. So I want to wait for a pullback to that 21-day line. And if I get a pullback to the 21-day, I'm going to be a buyer at that 21-day line on a stock that's moving like this. So right now, great stock, but it's not really buyable. And the reason it's not buyable is because it's just too far above that 21-day line. It's about almost 13% above it. Here's the thing to do. Wait a little bit of time. Hopefully this will pull back. If it pulls back to the 21-day line, that might be a great entry point for the XOM. And this is, of course, the oil and gas exploration E&P. Now, and here's the thing. This is where the action in the market is. It's in the explorers. It's in the refiners. Basically, this is a tale of two different markets. You have the oil and gas market, and then you pretty much have everything else. So, kind of tough market to trade. All right, thanks, Lisa, so much. OLXP. Let's take a look at that. OLXP, and see what is going on where. And hopefully, I get it up. OLPX. Excuse me. OLPX. A little bit of dyslexia going on there. All right, so there we go. Onaplex Holdings. Okay, this is the one. I heard about this one on the IBD Live this morning. By the way, that's a great show if you can tune into it. It does require a subscription, but it's definitely well worth it. Here's the thing I don't like about this chart. I know that it was people on the show liked it today, but I just don't like it, and I'll tell you why. Look at this chart. This is and I know it's perking up here, but on the daily chart, this is an IPO. It's still in a downward trend. If we go over to the weekly chart, you'll notice that it IPO'd here on 2021, and then boom, it went up and then down, and so it's starting to get more traction here. I'm looking at the weekly chart here. It's starting to get more traction, but it still needs to come up a little bit. So my take on this one is basically, this is I would be a watch list on this one on OLPX. I know that they have a good product, but I'm so worried with this lack of consumer, consumer ability to buy here. Now, it's true, Ulta Beauty, this is your question, the next symbol, Ulta Beauty is looking very, very good. And it is true that during periods of recession, one of the things that does do well is cosmetics, and this has been true since the 1930s. So, I mean, this is one thing that people don't. This is one thing that people, definitely continue to spend on in bad times, is our beauty products. So this may be one of the few areas out that in retail that I actually like. Is in this area. I haven't been focusing on this area just because I've tried to been focused where the strength is. But beauty products tend to do very, very well during downturns, and we definitely have a downturn going on, and so this might be a good place to get in. We're right below a buy point. We've had this nice consolidation. We're almost at the near all-time high. This is a $420 stock, and typically in retail, and this is a retailer. By the way, this is actually in the this is a retailer. Retailers tend to rise very quickly in their expansion phase, and definitely Ulta Beauty has been in that expansion phase. Their profitability is excellent. Their profitability has been their profitability has been excellent. You've had, let's see, over 20% increases in sales every quarter, and very, very nice. Also, their profits are moving up very, very nice. My only problem with this one is I just don't believe that the retailers. I just don't want to be in the retailers. I just don't want to be there, just because I think it's a weak area of the market, and it's just a weak area of the market. Tough place to be. All right, so let's see. Are you on YouTube as well? Absolutely, I am. This is from Tristan. Thank you for dialing in on this one. To get on to YouTube, just go to my profile, hit the link, click on it, and you'll see the live feed on YouTube. But I definitely am on YouTube, and hopefully on Instagram as well. So we're trying to see if that works today as well. All right, let's take a look for James for Wish. This one I wish was better. This one has been a kind of a meme stock. A lot of people have really gotten into it, but just look at this chart, and this chart just tells you just to run away as fast as you can. This one actually, when it came out, this is an IPO, and it came all the way up here to about 34, and then it went all the way down, and now it's about a $2 stock. Would I buy this one? Not on your life. This one is this is the reason why you need that 7% rule, because with the 7% rule, you would have gone down 7% and sold out, and then you would have been safe. Just think, if you had bought up here at March of 2021, you would have been in a world of hurt. I'm telling you, you would have been in a world of hurt. Would I buy this thing? No, not in your life. Companies can go under and just get delisted. So unfortunately, this one, I wish it were better, but it's not. It's just not a good. It's just not a good stock, and you just kind of gotta go away. All right, Joka says, what about Ford? And of course, Ford was doing great when Tesla was doing great, but now, unfortunately, Ford, similar situation to all the other automobile manufacturers. Unfortunately, I just don't know if we can really count this one in. We have a downward trend going on, and we have a death cross. So let's go back to the daily chart and show you what I'm talking about here. And there we go. Okay, so we have this downward trend. Oops. So we have this downward trend. Don't like seeing that. We have the death cross. That's right here. That's right here. This is when the 40-day moves below that 200-day. That shows weakness, and to see exactly when that happens, that's one of the reasons why we did that short on American Express, because right at this cross, that shows weakness, and boy, it has gone down. So I don't think, I don't think this one is going to go into the ground. I don't think Ford's going to be out of business, but I just don't think it's a good stock right now. It's sad, but I don't think it's a good stock right now. All right. Thank you, Damien. Do you have a target for TLT or TXN? No, But let's look at TLT and see TLT. Oh boy, that is really bad. Let's go over here to TLT. This of course is the one I have. This is different. Now this one is the positive ETF. I have the negative in one, which is the TBT. The TBT is as the interest rates go higher, the TBT goes higher. Now I own this one, and it's moving up. Pulled back a little bit after hours here today, but I do expect this one to go higher. Why? Because you can see that the shape of this is different. This is an upward trend, whereas the TLT, which is the inverse of this, is a downward trend. Unfortunately, look at that. Not good on that downward trend. Death cross. Just avoid this one. Just avoid this one for right now. Let's look at TXN. TNX, excuse me. TXN is Texas Instruments, which is a great stock. Just I wouldn't be buying it right now because of the market. But no, it's not going. Okay, so the one I was talking about is the TBT, and that one might be of interest to you. All right, let's take a question. What are we talking about? We're talking about stocks, boomer stocks. Okay, do tech. Okay, what was the last company? Let's see. Thank you. Okay, well, basically, I've been concentrating on. I've been concentrating on the oils, and why I've been concentrating on the oils. The best hedge against inflation are the oil stocks because it's used by everybody. So if the prices go up, well, guess what? Whatever you're buying had to get here some way, and that usually was on a truck. And those truck prices are the price of diesel determines the price of everything in the market that has to be delivered, which is about 95% of everything in the market. So the reason why the integrated refining oil companies are doing well is because the price of diesel is at an all-time high, and we're going to see more pain because, unfortunately, we have a government that is very, very tone deaf. It's run by academicians that really don't. They believe their theories more than they believe the reality. We need to get the price of diesel down. They're not going to do it, so everything is going to go up. Diesel right now is over $5 a gallon nationwide, so we want to be buying the refiners. That's where we want to be buying. Those are the ones that are going to do better than anybody else. Why? Because diesel fuel is needed literally for everything. All right, let's look at the SQQQ. What the SQQQ does is, of course, it's an inverse of the QQQ. It's a 2x inverse. And typically, you want to buy the SQQQ when you expect a when you expect a change in the overall direction of the Qs. And right now, it has been going lower. Why? Because, well, we've been in this little bit of an upward trend on the Qs, so this is inverse of that. I do believe if we move to a downward trend on the Qs, once again, that's when you want to be buying the SQQQ. So let's take a look at the QQQ to kind of see the overall direction of that ETF. If you can see, we're currently in a downward trend overall on the Qs. But we've had this little upward trend. This is the relief rally. If this fails, the day this fails, you want to buy the SQQQ because it moves against it. Right now, I wouldn't be in the SQQQ, but the QQQ looks like it's going to move lower, unfortunately. Right now, it's kind of treading water right here at about 309. But I do believe we're likely to get a pullback, and if we do, and that's what the retail sales are showing me. That's the reason why Target is such a critical. That's why Target, the Target news was so important today. Why? Because that is the harbinger, basically, of a future. That is the harbinger of a future weak retail market, and with a weak retail market, we will see the QQQ move lower. That's just likely because the Qs have a lot of technology stock in it, and so Czech is just not doing as well. Why? Because people are shifting to the area of the market, like the oil and gas area, that is producing positive returns. Right now, most of the techs are down. Some of them 50, 70%. Many of the tech stocks are down. So that's the reason for that. All of your stocks did. Oh yeah, absolutely. Oil and gas. Typically, oil and gas right now, and it's not going to be this way forever. But right now, because of inflation, and that's really the thing that you got to concentrate on, inflation. Inflation equals higher gas prices. The reason why we're having inflation now, a lot of the government will tell you, oh, it's fight inflation, all that kind of stuff, and a lot of it is just wrong. The reason we have high inflation is because we have low supply of oil and gas. Oil and gas creates inflation. If you have supply problems, and in this administration, unfortunately, the first thing it did was it canceled pipelines and it canceled production. Of course, they're gonna throw up their hands and say, "Oh, it would have been the same anyways." Absolutely wrong. Inflation is driven by energy prices. Currently, natural gas and oil are the driving forces of the economy. Even if you don't want to believe it, a lot of people don't want to believe it. I get it. I mean, I get it. People don't like. People don't like the fact that they consume oil and burn natural gas for energy. I get it, but it's it's reality. It's and a lot of people don't want to be in reality. And unfortunately, we have a government like that right now in this country. I want to show you the price chart for natural gas. This is a very, very key chart that I think that I don't know if you're interested in this one, but most electricity is generated from natural gas currently. And so the price of natural gas determines the price of electricity. So even though electric cars may not pollute, they're going to end up paying the same. They're going to end up the price of natural gas is going to end up being the primary input for these cars. So because natural gas has moved up so rapidly, you're going to see very, very expensive electric bills this summer throughout the United States, and already in places like Germany, they have the highest electric prices that they've ever seen, mainly because they stopped generating a lot of their electricity with natural gas, and it's really hurt them. So, yeah, whatever. Okay, CPG, because it's cheap like TGA. Oh, okay. Let's look at CPG. All right, let's look at CPG. All right, CPG, and there we go. Crescent Point Energy. Okay, nice. I like the fact that you're in the E&Ps, but I don't think you want to buy this one. All right, it's not the question of cheapness. It's the question of the chart pattern that it's in. I definitely think you're in the right neck of the woods. Oil and gas, Canadian explorers. This is a good area to be looking in. So what I'm gonna show. Let's see if we can find one that's set up better than Crescent Point. Let's see if we can do that. This is number 6. So let's look at the Canadian. Let's see if I can get this one up. Okay, this is the U.S. Let's look at the Canadian. No, let's look at the U.S. E&Ps first. That's probably going to give us the better one. All right, this is the Canadian E&P companies. Let's look at the companies that are in here. Crescent Point, of course, is at the top, so it's a big one. Canadian National. The only thing I don't like about CPG, Crescent Point, I like a lot on this one, but I don't like the fact that it's just not in position. It's just not at a buy point, and it's not any part of that. One I kind of like is this Vermilion. Let's take a look at this one. I kind of like this one. This, I think, is set up a little bit better here. This is VET, and I've been watching this one. This is right at a buy point. The thing about Crescent Point, it's a good stock. CPG is a good stock, but it's not set up well. Vermilion Energy is set up very, very well. And this one, basically, it's a Canadian company, but they operate in Canada, Australia, France, Ireland, just about everywhere, Germany and the U.S. So pretty big footprint. This one's a 99 relative strength. 99 relative strength right now, and it's at a buy point. The buy point is basically right here, right at this line, is 23.50. So that's the buy point on this Vermilion Energy. VET is the symbol on it. Nice buying action coming in here. If I was looking to add a Explorer, a Canadian Explorer, this is the one that I probably would add at this moment because because it's got a nice profile. It's in the right industry, and look at this, very nice profitability. Their sales are going up. Now, for some reason, I don't know why this happened, but they had a decrease 45%. I think this is an accounting thing because they're up 689% and then they're down. So they might have had some charges. They might have had some. Oh, I see. That's an acquisition. That's why. Acquired Lakota Exploration. So they bought a company. But look at this. This is a nice one. Nice cash flow. This is essentially a $24 stock, and look at this cash flow. 11.11. Wow, this is a 5 PE. So Vermilion Energy, this is the one that you might want to take a look at. It's buyable right now, and the symbol is VET, VET. So that's one that in the Canadian Explorers that might really do a great job for you there if you want to get into those. And I definitely think this is where you should be taking a look in the market. All right. Okay. Got to check it out. All right. Thank you. All right. Oh, Walmart, WMT. All right. I wouldn't recommend Walmart right now. Why? Because I just see a lot of weakness in the. I see a lot of weakness in the in the retail space. I mean, that's just a fact. Unfortunately, Walmart, of course, is the big kahuna. It's the biggest one. But look at this. This is the weekly chart that we're looking at. Look at how it fell off the cliff. Okay, it was trading up here really nice. It got up to this pivot. Boom. It had bad earnings. Look at that. Walmart was down. Let's see if I can show you that. Oops. Let me see if I can show you. I can get that up. Walmart had last quarter had bad earnings. Their profits were down 23%. Their sales were only up 2%. So on fundamentals, Walmart is going lower. Can you believe it? Walmart is going lower. That doesn't surprise me because Target announced today that they had a problem. So you can expect Walmart to have a problem too because, they're kind of in the same business. There's kind of two sides of a coin. Of course, Walmart's bigger. But if you're down more than 40% on this one, this is a potential, I don't really think this is a potential short because I think it's, I wouldn't like to short Walmart, but I think you got to be super careful with Walmart. I just think you got to, because I think that it's moving lower, unfortunately. Okay. What was the last company? Okay, trying to get okay. Really nothing to go over in tech. There was one tech company that I liked, and I think it may still be. I think it still may be buyable. I'm not buying it though, because it's just not in the right position. And this is ON Semiconductor, symbol ON on this one. The problem with ON Semiconductor is not the company. The problem is the market. It's still got 96 relative strength. It's moving up to this buy point. It's off a little bit after hours. Let's look at the 15-minute chart. I want to see how this traded today. Kind of flat, but we see some buying coming in. So if you're interested in tech, this is one of the ones I think you could probably nibble at. I wouldn't buy a full position in this one, though. I wouldn't buy a full position in this one right now. It's just too dangerous. But this one I like. It's ON Semiconductor. It provides it. The reason I like ON Semi opposed to some of the other companies is because ON Semi makes its own chips. It doesn't rely on it doesn't depend on TSMC or anybody outside to manufacture for them like NVIDIA and all the other companies do. They make their own chips, and they're based in Phoenix, so they don't have a supply chain problem, and they can deliver chips. And automotive chips, even though I think there are going to be some production backlogs, are in demand. So this is one of the ones that I would recommend. Well, I've yammered on here almost over a little bit over time. Let's see if we can get like one or two last questions in. Thank you. And the question is on ResMed. You know, this is probably one of the better areas to be outside of oil and gas. I think it's RMD, is that right? I think that's ResMed. I'm not sure. Yeah, ResMed. Okay, this is the symbol on ResMed. But here's what I don't like about it. I just don't like buying stocks that are below that 200-day line. The 200-day line's at 250. So you know what? I would pass on ResMed. I would pass on ResMed. It just doesn't. It's just not set up very well. So you know, I would pass on it. I would just pass on RMD. I would pass on it because it's just not set up very well. And in this market, we're in a downward trend, and we just don't want to be buying things that are going to probably move lower. And I think this looks like, even though it's rallied up to the 40-day line, I think it's going to reverse and go lower. This actually may be a good short. This one actually may be a good short. I'm going to put this on the short list actually for myself, RMD, because it does look like it may go lower. If it touches that 40-day line, very, very likely that we will see a short there. So I'm looking at this one possibly to short, believe it or not, even though it has a upward trending relative strength line. But this one does look like a potential short. Let's go to the monthly chart just to take one last view. Okay, I wouldn't short this one based on this chart. I think it's going to get some support probably here at the 200-day moving average. But I wouldn't buy this one. I just wouldn't buy this one right now. Just not a good long play. Just not a good long play here. All right, let's see. Last people here. Okay. All right. Well, everybody, I'm almost finished here. But if you want to, if you could, and I really, really appreciate this, if you could do this, please like and subscribe. That would be really great if you did. And we also have a free, a free list as well that we put out stuff. It's the action trailers. Just go to www.Dallas Trading Floor on that one. But please like us because it really helps. It really helps us get seen by more people, and I really, really appreciate it. I'll be back tomorrow at 5, and so everybody, hopefully you're doing well. Happy trading. Stay out. Be careful in this market. This is a treacherous market to trade. Tech just isn't doing well. If you're going to buy long, look at your oil and gases because that's where I think the values are right now in the market. But everybody just stay. If you're down more than 7% on stock, please consider selling it. Capital preservation right now is absolutely key. So I will see you tomorrow at 5. Happy trading, everybody. And if you're watching on TikTok, we broadcast live on YouTube every day. So you can see all the charts and graphs. And that's easy to get. All you have to do is go to my profile, click on the link, and you'll see it. It's at youtube.com/Dallas Trading Floor. I'll be back tomorrow at 5 o'clock. Thanks, everybody, for taking a watch here. Please like it. It helps us get out to more people. We're over 100,000 now, and I think we can get to 250. But please like our show and sign up for the free action trailers. I'll see you tomorrow at 5. Thank you so very much. There we go.